I know you should be listening to central banks. I know you should care about the US bond market, but you don't, because it's boring, it's dense, and honestly, drawing a trend line on a chart is a lot easier. So in this video, I'm going to show you how to use AI the smart way, to simplify fundamental analysis to get an actionable trade idea. Not by replacing your brain, not by turning it into a robot, but actually filtering noise, saving time, and improving trading decisions. This is fundamental analysis for traders who want to keep things simple. See, the real skill in fundamental analysis is knowing what actually matters and being able to filter out all the noise that is out there, understanding exactly what's the core macro view that matters. And that's where AI, when used correctly, becomes one of the biggest hedges a discretionary trader can have right now. Not to predict price, not to get trade signals, okay, listen me very closely here, but to simplify the analysis process so your decision becomes clearer, calmer, and more consistent. Before we go any further, I want to be painfully clear. AI is not here to tell you what to buy, tell you where to enter, or instantly turning you into a profitable trader. It's not that. Maybe sometime it will, but it's not there just yet. If you ask AI, is the USD going to go up tomorrow? You just lost the plot already, okay? Artificial intelligence is not a trader. Artificial intelligence is a filter, an analyst that can guide you and help you understand and decipher the context so you can make the best decisions. Think of it like this. You do not need to read 40 macro reports yourself. You don't need to read, every press conference transcript from the Federal Reserve. You just need the juice of it that actually matters. And artificial intelligence is extremely good at that. It absorbs all the nonsense and it hands you clarity. It filters out all the noise and helps you know what actually matters. This is what AI is good at. So if you want to simplify fundamentals, this is the first practical step. Your objective with AI is not to predict price, but it's to build a directional bias for an asset. Now, here's a real example of a prompt that you can use. You're an expert global macro strategist at a top-tier hedge fund. Your task is to analyze economic data, central bank sentiment, fundamental narratives, with a focus on forex currency pairs. Obviously, you can change this. You can put equities, whatever you want. You're skeptical, data-driven, but not overly reliant on data, very important. Forward-looking, even more important, and I'm going to explain you why in a second, and concise. You don't limit yourself to a surface-level analysis of the information you find. We don't want the AI to just spit out the information that it gets from websites and such. No, we want it to think 180 IQ with your own logic to verify the information, use reliable sources like institutional trading desk, Goldman Sachs, JP Morgan and such. We do this not to get their views and just copy and paste them, but we do this to get their views as contextual awareness, okay? Then the AI is going to think it through and understand, okay, Goldman Sachs is expecting this. Well, do I agree with that or not? So to get targets and context for your analysis. Think deep. I think this helps, maybe. Provide a directional bias on the best market trend to follow based on probability. Now, notice we're not asking it if EURUSD is going to go up or down tomorrow. We're not asking it to get us an exact trade signals. We're asking it step by step to do the analysis of all the data, the central bank statement, the forward guidance, the fundamental sentiment, to relate also to real institutional desks like Goldman Sachs, JP Morgan and such, to see what they're thinking and seeing, okay? Not as base for the analysis, but as comparison to see if there's confluence there or not. With all that, it's going to give us a complete context on probably the most important macro direction to follow. Okay, so as you can see, this goes on, it starts to search Goldman Sachs, their projection, and start to look for, JP Morgan. You start to search for context on the central banks, Bank of Japan, ECB, Bank of England. This is pretty deep. This is pretty powerful stuff. This is stuff that would take hours to do manually. And this thing does it in minutes. Extremely powerful. Now, keep in mind, this will not be perfect every single time. Okay, sometimes the pricing will be a little off, but let's get into it. Okay, First of all, it gives us a global macro overview. Now, this is useful for context, but we don't really need to focus on this, okay? The real value is gonna be down here, but we'll get to this in a second. So it goes to explain central bank sentiment. Now the Fed is in a dovish deal with two cuts high to 3% by mid-2026. ECB, though close to deep cuts, they're not gonna cut, we know that. Bank of Japan is slightly hawkish, they're hiking. Bank of England, further cuts. Okay, this is a pretty accurate assessment of how the central banks are moving. Now, Forex focus and directional bias. This is usually what the actual value in terms of traders this will be. So it usually will be down the bottom. First it goes on and it explains the global macro overview and context, the sentiment for the central banks, okay. Then it goes to say, majors show USD overvaluation. JP Morgan thinks the dollar will decline about 3%, okay. Goldman Sachs thinks the dollar against the Chinese yuan will the value goes to 5.0, it's currently at 7.1. This, if you understand a little bit of macro, you understand that if the Chinese yuan strengthens this much, the dollar weakens pretty much across the board, but okay. High conviction appreciation, okay. But strongest probability trend, USD Japanese yen, current 156, down to 139. Bank of Japan hikes, compresses downgraded rates, unwinding carry trades, Fed cuts erode differential, that's absolutely true. Best macro play, short the dollar against the Japanese yen for a sustained downtrend. Now, this is the idea that the artificial intelligence is giving us research. Now, it's thinking quite fundamentally here, okay? It understands the Federal Reserve is going to cut in 2026, and it understands that the Bank of Japan is going to hike in 2026. It understands rate cuts are bearish, rate hikes are bullish, so it thinks that USD JPY is going to go lower. Perfect sense. This makes absolute sense. Now, I would argue the dollar against the Japanese yen is not going to be quite the right expression of it because the Japanese yen is conflicted a little bit with the fiscal side of it, but I don't want to get too much in the weeds. What I want you to understand is that we wanted to make sure that the AI actually thinks about this trade idea quite deeply, okay? So we don't just put the prompt and do it once. We want to send the same prompt multiple times to the artificial intelligence. If we send the prompt 4 or 3 times and it says 4 out of 5, it says short USD JPY, then okay, we're looking at something there, okay? That's an interesting one to consider. But the point is, don't hit sender and just rely on whatever it says the first try. Run it a couple of times, run it 5 times, for instance. If every single time it gives you a different trade, maybe there's not really anything solid to actually keep an eye out for out there, okay? If 4 times out of 5 it suggests instead to look for USD JPY downside, then this could be something you gotta be looking at. Now, as you can see, we run it another times, and this time instead of suggesting USD JPY short, it suggests long Euro USD. Bias stems from the Eurozone rebound outpacing US slowdown fears, which is pretty true. Labor market in the US is actually slowing down, and instead in Europe it's pretty stable. Inflation is actually picking up a little bit, but it's actually going down in the US. So ECB stability versus Fed dovishness. Now, as you can see, we're running out of the time. It's not all its research. It's giving a little bit of a different output. So what I want you to understand here is do not just send this once, get whatever the AI is going to tell you, okay, and just go look at the chart. No, run it a couple of times, get a bunch of ideas, and you will start to see the connections between the two. So basically, this prompt and the previous prompt that we used essentially have the same macro view behind it. USD weakness because the Federal Reserve is going to cut rates. And so it suggests to pair that USD weakness against, previously it suggested the Japanese yen, now suggesting the EU. I've got to say, I prefer, as of right now, as of making this video, I prefer the long Euro USD because, again, the Japanese yen is a little mixed in its fiscal policy. But let's run this another time, a third time, and let's see what it gives us. Okay. Third prompt, third output, again, same overall macro view. Macroeconomic landscape supports the transition from US exceptionalism towards a more balanced growth. central banks divergence narrows, the Fed eases with 2 or 3 cuts potentially in 2026, pausing obviously if labor market softens less than expected. ECB holds, also fiscal boost in Germany is supporting, resume growth. This is absolutely true. So again, the view is the highest probability macro trend is USD weakness against a basket of the G10 currencies, with Euro USD long as the cleanest expression. Target 122, 125. So a third prompt, again, same on the line view, dollar weakness. And so we got in 3 prompts, in about 5 minutes, 6 minutes, we already got the potential view and trade idea for the next couple of months. Now listen to what I'm about to say, because it's going to make the whole difference on whether this will actually work for you or not. Now, if you go out there and just trade on what the artificial intelligence tells you, with no timing, you're going to get in trouble. AI is not here to make decisions for you. AI is here for compressing data, highlighting and finding potential opportunities, and do it all in minutes instead of hours. But it absolutely does not and should not tell you when to enter, where to place your stop loss, and when price is ready to move. Timing. Even if it tells you so, even if the output will give you the exact entry price and stop loss, do not rely on that. Just use the directional bias, just use smartly the AI to do all the research that will take you hours to do and do it in minutes. Then we go and look for a trigger, technical trigger to position with just basic technical analysis. Now, some AI models will work better than the others. Some will just hallucinate most of the times. I've noticed ChatGPT is the least reliable. Grok is great, but to solve the problem, I've actually created my own AI strategist, which I personally trained with all our knowledge and has access to the exact market information necessary to make the most accurate analysis possible. And this doesn't need custom prompts. Just can ask it, it'll use the analysis. It's going to go with all its internal knowledge, which is custom trained by me, with all our knowledge, with all our data. It's going to go and analyze, so it knows exactly the pricing. It's a lot more accurate, and it gives, the same kind of analysis that I would personally give, because it's actually trained by me. This tool is available for private network members, but hey, you can do this with Grok 4 as well. And as you've seen, the output is pretty good there too. That said, this is where I need you to really pay attention. Entering trades just because the fundamentals say so is one of the fastest ways to get frustrated. See, I've seen a lot of traders fall into this. They understand the fundamental context. And as soon as they understand it, as soon as they think something will move in a certain direction because fundamentally it says so, they rush into the market at the high. Price inevitably pulls back. They get stopped out and they think, well, fundamental analysis doesn't work. Until what? Price moves in the expected direction fundamentally. It continues the macro trend, but without them, because they're being stopped out. So what they do, they repeat the whole cycle again. They chase at the highs, price pulls back, they get stopped out, price moves without them. You have to break this cycle. And the way you do that is with simple and extremely basic technical timing. Fundamentals for direction, technicals for entry. Fundamentals tell you why and in which direction a trend should happen. Technicals tell you when to enter that trade, when to position, when the timing is right for the continuation of the macro trend. Now, if this video helped you see fundamentals a little bit differently, in a more smart and efficient way, hit the like button. It tells me this content is actually worth making. And subscribe if you want a trading education that's actually useful, like this.